One of the most powerful strategies from trading is not just the charts, it's about conviction. I could tell you in this video how to trade core CPI, which I'm about to do, but unless you show up and you have those confirmations and you have this conviction when you're sitting in front of the charts to take the trade, then nothing I'm going to say to you will matter. What's going on, everyone? The name is Sir Hans Felix. If this is your first time seeing me as well, I hope this isn't your last. In this video, I'm going to show you how to profitably trade core CPI. Core CPI is Consumer Price Index. Now, it sounds fancy. It sounds like you had to sit in a damn economics class, which you could have. But the truth is, it just means how are we doing as an economy and what those numbers are going to reflect as far as prices at the grocery store, at the gas station, and so on and so forth. I've been trading since 2015, and let's be honest, there's been times I was really excited to trade core CPI these past 2 to 3 years where sometimes the markets just would not react the way I would have wanted, and it taught me a lot of things. Number one, why does core CPI matter? Well, when you step outside, based on the numbers that the core CPI is showing you, you will see the reflection of those prices. You'll notice typically when core CPI numbers are negative or it's a lot less than expected, you will see it has direct impact on the charts and in the real world. The feds and these financial institutions, they use those metrics to determine whether we will have an increase of interest rates later down the line or in the next FOMC slash Fed rates meeting. I do want to let you know, and this is a cheat code. Once you understand core CPI, then it opens up the gates of you understanding the other fundamental news that are tied to it. Because fun fact, did you know core CPI numbers based on the data that comes out also gives you insight on how NFP numbers are going to look like, or possible FOMC interest rates results are going to be determined just based off of core CPI because it all ties in together. I bet you didn't know that, huh? I want to show you guys more of what I'm talking about on the charts, so let's get to it. Now, first and foremost, I want to let you know, you should know by 8:15 Eastern time if you're going to be trading core CPI or not. And I'm going to tell you why. Number one, you have to have a solid trading plan. And let's be honest, you have to go into trading fundamentals if you really need to trade fundamentals that day with a idea of how much you're going to be risking. That is super, super important. All right. What everybody tells you is, okay, all right, let me teach you how to trade fundamentals. But what they don't tell you is, unless you already had a risk plan or unless you even was up for the week or for the month, it's not necessary to trade a high impact news because anything really could happen. But at the same time, it gives you mindfulness to go into a trade knowing that, hey, if I made $1,000 this week or this month, I'm just going to risk a portion of my profit, a portion of my earnings to go about taking a trade during a high impact news day. Okay. So that right there is fundamental gems with a little bit of psychology. All right. Now, one thing I've learned about core CPI is this. Number one, you have to check Forex Factory, or when it comes to fundamentals, I use this trusty platform right here, which is called Funda Bias. It puts all the news in one, powered by some powerful AI. And right there and then, I'm able to get a summary of what to anticipate. So shout out to Funda Bias. You guys are doing a great job making it so simple for traders. Whether you started trading today or it's been 10 years since you've been in the game, this will serve you as a great tool to back your fundamental bias. All right. So now let's get back on the technical side. Here's what you need to know about trading core CPI. The numbers that come out is very important. For example, when you look over here on Forex Factory, you will notice before the news drop, there's a forecast and there's a previous number that came out. All you have to really focus on is number one, looking at the CPI M/M, which is the month to month. What does the numbers look like they're going to be? Because here's the thing, right? If the numbers come out less than anticipated, then that means the dollar is going down because it has direct correlation with the US dollar, which is the DXY. Okay, so I have it right here, the DXY. Pay attention. Soon as that 830 drop, you're going to see a reaction out of the market. If the numbers, let me write it down. If numbers come out lower than expected, y'all not about to act like I don't know how to spell, then the DXY, which is the dollar, the US dollar index, will react negatively. Now, just because I'm saying negatively, that doesn't mean it has a negative connotation to groceries. In fact, you might see prices of goods, all right, things that we purchase might slightly go down for the next couple of weeks, whatever, whatever. And that also tells the Fed whether they should increase interest rates or keep interest rates the same or lower interest rates on the next Fed rate meeting. Okay. So in this case, we just had interest rates news back in late June, I believe, late May. But this month alone, we will be having FOMC on the 29th. Okay. Stay with me. If you know what the numbers of core CPI come out as, then you already know what the numbers for NFP will be. The last time we had FOMC, the feds, they maintained and kept the rates the same. And if you pay attention, these past couple of months, we have been keeping interest rates the same since December 10th, 2025. If we're seeing that every time core CPI numbers come out and the numbers are negative, right, lower than expected, then what will end up happening is the interest rates are either going to stay the same or they're going to look at the economy and say, you know what, it is probably time to decrease interest rates because the economy is cooling off coming from inflation. All right. Now, let me also show you a little bit of a cheat code. If the numbers come out when you look at the month to month data as higher than expected, for example, let's find one here. Boom. September 11th, 2025. The forecast was 0.3%. But when the news came out, 0.4% was what ended up printing. That means the numbers came out higher than expected, not significantly higher, but at least higher. So each time you notice that the forecast was a certain number and they go at least zero point 0.1 or 0.2% lower than expected, you will expect the US dollar to react bearish in these conditions. A few occasions where this happened exactly as anticipated. Now, notice May, just about 2 months ago, the numbers that was forecasted was 0.6%, and 0.6% came out exactly as anticipated. Now, when those numbers come out exactly as anticipated, you do not want to trade core CPI that day because the market will be wishy washy. Everything's even Steven. It doesn't much give an anticipation for price to give a clear direction. All right. So you want to avoid when the numbers come out exactly as is. This also happened in January. It happened in March. And you're going to see how each time that happened, the conditions were not good. Also, this happened in May and it happened in June as well. So this month is like the only month out of the last couple of months where the numbers came out and it turned out to be less than expected or higher than expected. So this is why today we got to see like a big push out of the market. All right. So there's that. Now, another thing I want to let you know is this. If you're going to trade core CPI, you only need the first 15 minutes out of that 830 candle, and whatever direction the market is going to go is going to head there with aggressivity. So you only need to be in a core CPI trade from the 830 Eastern time to about 845. Once that happens, you really don't have to stay in the trade. You need to start closing partials or you need to close the trade entirely. And I'm going to tell you why. Because price tends to actually return back to cover or fill those positions later on in New York by 9:30. So notice that the market ran, but by 8:45 they stopped going in that direction. They pulled back. They came back to retest that same zone later on, not too long after, right? and then they pushed back within that direction. So imagine if you were in a trade going to the downside, you would have lost those positions by staying in too long. All right. So this is why if I'm trading gold, for example, right, I show up within the first 15 minutes of 8 a.m., where I mark out the low of the day, which is usually in London. And so by 8:15, if the structure still looks in the direction that it's intending to go, I will risk accordingly and I will place my stop loss below the London session low. And look, whatever happens, I'm okay with. And you have to put that in your mind when trading fundamentals. Whatever happens, I'm okay with, because I've traded core CPI before, and there are times, where the market is not as clean as you would have anticipated. And usually, what had happened in the past, which is why I stopped trading core CPI so often, is the market might whipsaw, sweep the previous session low, and then run right back up. Or sometimes it'll sweep the session high of London and it'll just reverse. And what tends to happen is your stop loss gets wrecked, or sometimes servers might freeze and then you end up being in nasty drawdown more than anticipated, which is not good. That's why I tell everybody, like even my students, when you're trading core CPI, make sure you have some buffer. Make sure this is not your first trade of the week. Make sure it's not your defining trade of the day or of the week, because we're now going into the second portion of trading core CPI is you don't have to trade the 8:30 open, meaning you really could sit on your hands and either not trade that day, or you could literally wait about an hour after 9:30, because as I was saying, price tends to pull back in anyway, and it gives a lot more clarity to enter the trade once price gives a retest. For example, today with gold, which I honestly feel was super choppy after the core CPI. But as you can tell, this 8:30 candle right here, price pulled back into it. Remember, after 15 minutes, you don't want to be in that 8:30 candle because price does retrace. But look, by 9:30, 9:45, and 10:30, you had more than enough price rejection, creating a low for you to take a trade and place your stop loss below this low right here, and you would have still ended up making a good profit, a one or a 1 to 2 ratio. Let me show this to you in other charts. I'm sure some of you guys probably traded today as well. Look how price took off and left a gap on US 30, but within that 15-minute time range, the market pulled back, and here it is coming right back at 9:30 into this candle or this gap right here. So it really doesn't make sense for you to have to rush anything, knowing that price will come back not once, sometimes twice. Look, again by 11:30 and 12 p.m. in that same range, that same area where price came from at 9:30, at 8:30, and you could literally take a much more cleaner, more peaceful position, knowing that price have now retested that 8:30 volume. Let me show it to you on Nas 100 for those of you guys who trade Nas 100. This was 8:30, right? Price took off. 15 minutes went by. We noticed the price retraced. But personally, if I was trading Nas today, I would have much rather price pull back into this whole volume of the candle that occurred during 8:30. And that to me is a much more calm and less riskier trade, to know that price retested the zone. And I'm going to just put my stop loss right under there, the London low or the 8:30 candle, and up and away it goes. In about 15, 20 to 30 minutes, I'm in profit and I'm targeting the recent high. That's all I need for the day. All right. So as you grow older into this journey, as you mature into this journey, you take so many L's. You start to be more cautious and highly selective of the trades you take, rather than just trying to be here for the hype. And again, it takes away from having to be so anxious to take the trade or even lose a whole lot out of one single day. And guess what? There's another day coming. It doesn't have to be the end all be all highlight of your trading week. We could literally wait the next day and trade just fine. All right. So, this is typically what happens in a day where the market drops interest, core CPI news, and the numbers come out significantly lower than expected. You will see indices buy, you will see gold tend to buy unless we're sitting at a 4 hour structure supply zone. They might buy it and then yank it back within the range. That tends to happen. But if you're going to trade this, I would rather go with option number two. Just wait after 8:30. Start looking at the market from a 9:45, 10:30, 11:30. Just trade later as possible, just waiting for a retest, which I think is the most profitable way to trade core CPI from experience. Now, you might want to do your own experience, but get back to this video and let me know which one you like better. All right. So, in conclusion, if you're going to trade core CPI by 8:15, target, if the market is already bullish, target the recent session low, which is London. Look for a 5 minute break in retest. And by then, make sure you have some breathing room. Put your stop loss below that low and up and away it goes. If you're going to trade a pair like, let's say, USDJPY, which in this case would be bearish based on the data that comes out, make sure you put your stop loss above session highs. All right. So the previous session high would be about right here, 5 a.m. to 7 a.m. All right. These would be where your best stop loss would be placed, anticipating what will happen next within the next 15 minutes. All right. And if things are a little too hot, just stay out the kitchen. Stay out the kitchen. You'll be just fine sitting on your hands. All right. So, last but not least, before we make this video too long, let's go ahead and show what happens when the market comes out even Steven, like June and May. So, June 10th, 2026, let's see what happened with the markets just so I can show you guys. Let me go down right here, hit go to, and we're going to go to the previous month, June 10th, 2026, 8 on my own on a higher time frame. Okay. So June 10th, 2026 was about right here. And as you can see, that was a chaotic day. Like it was a disaster. It went up and it went down. It was choppy. And the first place they went looking for is the previous session low. And they was up and out of there. All right. Now, if you traded that just fine, cool. But you can see the difference between a number that comes out even Steven versus a number that comes out lesser than expected. Let's go ahead and check May real quick. So that said May 12th. Yep, May 12th, 2026. Let's go right here. Okay, this is still USDJPY just to show you. Numbers came out exactly as anticipated, which is not always a good look. And look how choppy that was. Right at 8, it was choppy, right? You couldn't really tell where price wanted to go. Let's go to US 30 and see if price did the same thing. Okay, so we had June 10th and May 12th. All right, so let's go right here. June 10th. So that was a Wednesday. I believe it was around here. Yep, June 10th. As you can see, you couldn't really tell what the market wanted to do, and it went straight to the previous day's low, and then it pushed right back up, and it was just wishy-washy. That is why, ladies and gentlemen, you do not trade core CPI if the numbers come out exactly as anticipated. It's either you will find your edge once price is higher than anticipated, which will push the market, the dollar index upwards, which is going to give a negative connotation to the US equities markets like US 30 and NAS. And then gold will be bearish for the next 15 minutes. Okay. So that is how you trade core CPI. Much better to just trade it after the fact So that way you have enough time to see what the numbers came out being. If price retests the previous 830 candle, you have a much cleaner opportunity for entry. And three, make sure you have some capital and equity to risk comfortably during core CPI. And that's it, guys. Hopefully, this video brought a lot of value to you. I'll see you next time. This ain't your first time on YouTube. Make sure you like and subscribe.